You know, usually when we talk about putting together a perfect retirement plan, there's this expectation of absolute bulletproof security.
Right, for sure. You feel invincible.
Yeah, exactly. It's a lot like building a luxury yacht. I mean, you spend years checking the engine, charting your course, reinforcing the hull, and eventually you confidently set sail into your golden years.
You've planned for the big, obvious storms. You've got that buffer for market downturns. You've factored in inflation spikes. And you just feel incredibly solid. You really think you've thought of everything.
But then you look down, and despite all that meticulous planning and, the stress tests, there is a massive hidden six-figure leak right in the bottom of your boat.
Yep, you are actively taking on water.
And the worst part is, you might not even realize it until years after the damage is actually done.
Well, it's the ultimate stealth tax. I mean, it operates completely in the background, quietly draining your resources while you're looking the other way.
Usually staring at your federal income tax return.
Right.
Right. Completely ignoring your health insurance premiums.
Exactly. People just gloss right over it.
So that stealth tax is called Medicare IRMAA, and today we're going to completely expose and demystify it. The team at Davies Wealth Management down in Stuart, Florida, actually asked us to dig into this specifically for their Treasure Coast listeners.
Right, for the 1715 Treasure Coast Financial Wellness Podcast.
Yeah, this deep dive is for them because, frankly, if you have a portfolio over $1 million or maybe a substantial pension or concentrated stock, the standard mass market advice is just going to sink your ship.
It really will. Davies operates as a fee-based fiduciary, and they see this constantly.
Yeah, high net worth retirees losing literally hundreds of thousands of dollars to an entirely avoidable recurring tax. And it's just because they didn't know the rules of the game. So, to you, the listener, we are going to unpack how this system works and, more importantly, how to protect your assets. So let's start with the basics. What exactly is this leak? What is IRMAA?
Right, so IRMAA stands for Income-Related Monthly Adjustment Amount.
That sounds incredibly bureaucratic.
It is, yeah. When you strip away all that jargon, it is just an additional premium that gets slapped right on top of your standard Medicare Part B.
And Part B, that's the one that covers your doctors and outpatient stuff, right?
Exactly. That, and it also hits your Part D, which is your prescription drug coverage.
Okay, so for context, the baseline standard premium for Part B is what, around $185 a month for 2026?
Yeah, that is the baseline. For the vast majority of Americans, Part B is roughly that $185 a month. But Medicare uses this sliding scale based on your wealth, or, well, more accurately, your income.
Right.
If your income's specifically a metric called MGI, which is Modified Adjusted Gross Income, if that crosses certain thresholds, that premium just skyrockets.
Oh, wow, really? How much are we talking?
You could suddenly find yourself paying over $600 a month per person.
Per person?
Yeah, that is more than triple the base premium, and we haven't even factored in the Part D surcharges they add on top of it.
Okay, so what does this all mean for a married couple entering retirement? Let's talk real dollars and cents here, because a few $100s a month might not sound, catastrophic at first glance to someone with a healthy portfolio.
Well, the math gets frightening very quickly when you zoom out. For a married couple where both partners are on Medicare, these surcharges can easily add $15,000 to $20,000 or more in a single year.
Just an additional mandatory premium.
Yep, just to have the exact same health insurance as the person paying $185.
That's essentially buying a new car every couple of years and just handing the keys straight to the government.
It really is. And the real danger is that it compounds over time. If you look at actuarial tables for a healthy 65-year-old couple today, there is a very high probability that at least one spouse lives well into their 90s.
So you're paying it for a long time.
Exactly. That translates to 25 years of paying this stealth tax. So 20 grand a year over 25 years. You're looking at $375,000 to $500,000 in purely avoidable lost money right out of your nest egg.
And we also have to factor in what that money could have done if it had, stayed invested in your portfolio.
Right, the opportunity cost.
Yeah, if we assume an opportunity cost, say, leaving that money invested in a conservative portfolio with just a modest 5% return, that $500,000 balloons to a staggering $715,000.
It's crazy.
That is a life-altering amount of money.
That is the true cost of failing to plan for IRMA. And to make matters worse, the thresholds where this tax kicks in, they operate like cliffs. They are notoriously steep.
What do you mean by cliffs?
Well, for example, looking at the projected 2026 brackets, if a married couple's MGI crosses just over the $267,000 threshold, they don't pay just a little bit more.
Right.
They're suddenly paying roughly $10,600 more per year than a couple earning, say, $212,000. You cross a single invisible line by one single dollar, and a massive bill drops right in your lap.
Okay, let's unpack this, because here is the most bizarre, counterintuitive part of the entire system, right? The timeline.
Oh yeah, the timeline is wild.
When most people think of a tax or a premium, they just assume it's based on what they are earning right now. But the Social Security Administration doesn't look at your current income to decide your Medicare bill. They use what is called a 2-year look-back.
Exactly.
Meaning the premiums you pay in 2026 are completely dictated by the tax return you filed for 2024. This look-back rule is like getting a massive speeding ticket in the mail 2 full years after you actually drove fast.
That is the perfect way to describe it.
Wait, so if I have an amazing year in the market in 2024, or I finally sell a piece of commercial property, I get suddenly punished for it in 2026 when I might be fully retired, sitting on a beach, and earning much, much less. That feels like a trap.
It absolutely feels like a trap. And for the unprepared, it functions perfectly as one. What's fascinating here is that the government isn't doing this maliciously. They're just operating on an administrative lag.
Right, they just don't have the data.
Exactly. In late 2025, when they calculate your 2026 premiums, the IRS doesn't have your 2025 or 2026 tax data yet. So they rely on the last complete verified tax return in their system, which is from 2 years prior.
I mean, I completely understand why it feels incredibly frustrating.
But for high net worth individuals, understanding this lag is actually a massive strategic advantage.
An advantage, wait, because we have a 2-year warning to brace for impact.
Not just to brace for impact, but to steer the ship entirely. This is why mass market advice like just try to stay below the income threshold is entirely useless for the listeners tuning in today.
Yeah, that doesn't work for them.
If you have a $3 million traditional IRA, you can't just decide to earn less when the government eventually forces you to take distributions from it. You have to play a multi-year chess game.
So because we know that 2024 income dictates 2026 premiums, we can manipulate the timeline, move the pieces, and change the outcome before the look-back window even opens.
Precisely.
Which brings us to our first major strategic move. If we know the clock is ticking, we need preemptive strikes. And one of the most powerful tools available is the Roth conversion ladder.
Yes, a hugely important strategy.
The concept here is to convert traditional tax-deferred IRA assets over to a Roth IRA specifically before you turn 63. The math is simple, right? Medicare starts at age 65. With a 2-year look back, 65 minus 2 is 63.
Exactly. Age 63 is when the government's camera turns on and starts recording your income for Medicare purposes.
So that age 63 milestone is arguably one of the most critical dates in retirement planning.
Without a doubt. The reason we focus on Roth conversions before that camera turns on is because Roth distributions have a superpower. They are entirely invisible to IRMAA.
Completely invisible.
Yes. When you pull money out of a Roth, the government does not count it towards your MEI.
Hold on. I want to play devil's advocate here for a second.
Sure.
I am volunteering to pay a potentially massive tax bill today out of pocket on a Roth conversion just to avoid a Medicare surcharge a decade later.
I know how it sounds.
How does taking a guaranteed financial hit now make mathematical sense for the listener? Like, I'm writing a check to the IRS today for what? The privilege of saving on health insurance premiums later.
In a very valid pushback. And it feels deeply counterintuitive to anyone who has spent their entire life trying to defer taxes. But if we connect this to the bigger picture, this strategy is about controlling your taxable footprint before the government forcefully controls it for you.
What do you mean by controlling the footprint? Give me the mechanics of that.
Well, think about the alternative. Consider what happens if you do not convert those funds. You leave that $3 million sitting in a traditional IRA. It grows tax deferred. You feel great.
Right.
But eventually, you hit your 70s and the IRS steps in and mandates required minimum distributions, or RMDs. They force you to pull a percentage out every single year, whether you actually need the money or not.
Oh, I see.
Those RMDs for a multi-million-dollar account are massive. They are fully taxable as ordinary income, and they will forcibly push your ANGI through the roof every single year of your late retirement.
And that permanently triggers maximum IRMAA surcharges until the account is depleted or you pass away.
Exactly.
Ah, I see the whole board now. So the RMD is the real villain of this story. It's like this unstoppable force that just pushes your income over the cliff.
That is the core issue. By choosing to pay a known controlled tax rate today during a calculated Roth conversion, especially if you happen to live in a state with zero state income tax, like Florida.
Right, like where Davies Wealth Management is based.
Exactly. You are surgically removing the very asset that causes the IRMAA problem later. You deplete the traditional IRA on your terms at your tax rate so that when you are 75, your RMDs are zero and your Medicare premiums stay at the absolute minimum.
That makes total sense. You're trading a controlled, one-time burn in your early 60s for avoiding a lifetime of compounding stealth taxes in your 70s and 80s.
Exactly right.
And that ties right into another critical concept, right? Income timing. If you know the two-year look-back is a chessboard, you control when the pieces move. You can strategically defer selling capital gains until a year where your income is naturally lower.
Yes, deferring is key.
Or if you're selling a business, you might use installment sales to spread out the income over many years, rather than taking one massive lump sum that blows up your look-back year and ruins your IRMAA tier.
That kind of forward-looking maneuvering is absolutely essential. It is all about manufacturing what we call clean years.
Clean years.
Yeah, let's say you do some tax projections and realize that no matter what you do, you are going to be in the absolute highest IRMA bracket this year. You've already crossed the threshold. In that scenario, it might actually make sense to purposefully accelerate extra income into this year.
Wait, really? Earn more on purpose?
Yes. You pull forward capital gains or take larger IRA distributions. You take the heavy hit all at once in a year that is already ruined for IRMAA purposes, so that next year your taxable income drops dramatically, creating a clean year that saves you from surcharges 2 years down the road.
So Roth conversions and income timing make perfect sense if you're 60 and planning ahead. But let's pivot to the listener who is sitting there thinking, well, that's great for the youngsters, but I'm already 72. I'm actively dealing with these massive RMDs right now, and my look-back window is permanently open. Is it too late? Are they just out of luck?
Not at all. There are powerful structural maneuvers designed specifically for that stage of life. If you're over age 70 and a half and you are charitably inclined, the single most effective tool in your arsenal is the Qualified Charitable Distribution, or QCD.
Walk us through the mechanics of a QCD. I mean, how does giving money away save my Medicare premiums?
A QCD allows you to direct funds up to $105,000 per person, which is the limit for 2026, straight from your traditional IRA to a qualified 501c3 charity. The beauty of this mechanism lies in how it bypasses your tax return entirely. Normally, taking money out of your IRA to give to charity counts as taxable income first, which inflates your MGI, and then you take a deduction later.
But the QCD skips that first step.
Exactly. A QCD goes directly to the charity. It legally satisfies your required minimum distribution for the year, but it completely disappears from your gross income. It is as if you never even earned that money.
That is a massive loophole. So if a married couple is heavily involved in their church or local animal shelters or university endowments, they could potentially drop $210,000 completely off their MGI in a single year.
It is a profound shift in taxable income. That $210,000 reduction alone can instantly drop a couple down 1, 2, or even 3 entire IRMAA tiers, saving them thousands in premiums, all while supporting the causes they care about.
Okay, that covers the IRA side of things for our older listeners, but what if the issue isn't a retirement account? The team at Davies Wealth Management frequently works with business owners or executives sitting on massive amounts of concentrated wealth.
Right. Highly concentrated assets.
What if a listener has a huge block of restricted stock units, or they are about to sell a private medical practice for $10 million? How do you hide that from the 2-year look-back camera?
Well, a lump sum sale of a highly appreciated asset is the absolute worst-case scenario for IRMAA. If you sell an $8 million business outright, you realize an $8 million capital gain in year 1, your MEGI goes to the moon.
Right.
You blow through every single threshold, and 2 years later, you are paying the absolute maximum Medicare surcharges, along with devastating capital gains taxes. To prevent this, we utilize a structure called a Charitable Remainder Trust, or CRT.
A charitable remainder trust. Okay, so instead of a massive sudden flood of income that drowns your tax return and spikes your IRMAA, a CRT is like building a dam that lets out a controlled, highly manageable trickle of income over time.
That is a brilliant way to conceptualize it. It functions exactly like a hydroelectric dam. When you have this massive appreciated asset, let's say $5 million in company stock, you don't sell it yourself. Instead, you legally transfer the ownership of that stock into the Charitable Remainder Trust.
And because the trust is charitable, it operates under different rules.
Precisely. Once the trust owns the stock, the trustee can sell it on the open market. Because it is a tax-exempt entity, that sale does not trigger any immediate capital gains tax. The dam holds all the water back.
Wow.
The full $5 million is preserved inside the trust. Then, the trust is legally structured to distribute a steady, predictable income stream to you, the donor, over your lifetime or a set number of years.
You're just letting a little water through the turbines at a time, maybe $250,000 a year instead of $5 million all at once.
That is the magic of the structure. You have effectively smoothed out a massive, concentrated spike of wealth into a manageable annual stream.
And that keeps you under the cliff.
Yes, by spreading that taxable income across a decade or two, you keep your MGI steadily below those brutal IRMAA thresholds. Plus, you receive a significant partial charitable income tax deduction in the very year you set it up. For business owners selling a company or executives offloading stock, this structure is a complete game changer.
Here's where it gets really interesting, though. So far, we've talked about managing big, flashy moves, million-dollar IRA conversions, selling businesses, massive charitable trusts. But what about the quiet, supposedly conservative investments sitting in a listener's portfolio?
Oh, yes.
Because as I was going through the research, I found what I think is the most dangerous hidden trap in the entire Medicare system. I'm talking about municipal bonds. Municipal bonds are famous for being the ultimate tax-free safe haven. Are you telling me that a tax-free investment actually triggers a massive Medicare bill for our listeners?
It does, and this trap catches so many affluent retirees completely off guard. The disconnect stems from the difference between how the IRS views wealth and how Medicare views wealth.
Okay, how are they different?
The IRS looks at your standard income to determine your federal tax bracket, but Medicare uses MAGI, Modified Adjusted Gross Income. The government essentially says, we need a more comprehensive picture of your true wealth to see if you can afford higher health premiums.
Right.
So they take your standard income and they add certain things back into it. And one of the largest, most common add-backs is tax-exempt municipal bond interest.
Wait, so the IRS says this interest is completely tax-free, don't worry about it. But the Social Security Administration looks at the exact same tax return and says, nope, we see that tax-free interest and we're counting every penny of it toward your Medicare threshold.
That is exactly how the mechanism works. It is completely shielded from federal income tax, but it is explicitly added dollar for dollar to your MAGI for IRMAA calculations.
That is wild.
You could have a conservative retiree who buys a massive portfolio of munis specifically because their previous advisor told them they needed tax-free income in retirement. They think they are being safe. But suddenly they get a letter in the mail hitting them with a $20,000 Medicare surcharge entirely because of that tax-free interest.
That is the very definition of a stealth tax. You think you're hidden, but they have thermal vision.
It really highlights the crucial difference between an investment being tax-free and an investment being IRMA-free. Municipal bonds are not inherently bad investments, but for high-net-worth individuals, you can't just look at the coupon rate. You have to meticulously calculate their true after-tax, after IRMA yield.
Which leads right into the concept of asset location. I want to be clear here for the listener. We aren't talking about asset allocation, which is what percentage of stocks versus bonds you buy. We are talking about asset location, which is where you physically hold those investments across your different accounts.
Location is everything when it comes to avoiding IRMAA. Because of this muni bond trap, it might actually make far more mathematical sense to hold a regular, fully taxable corporate bond inside a Roth IRA.
Because Roths are invisible.
Exactly. Remember, distributions from a Roth are truly IRAA-free. So a corporate bond in a Roth yield completely invisible income. Conversely, holding a tax-free municipal bond in a standard taxable brokerage account inflates your MGI and pushes you toward the cliff.
So, proper asset location can artificially lower your MAGI by tens of thousands of dollars without you ever changing your actual risk profile or your underlying investment strategy.
Yes, it's incredibly powerful.
That is just brilliant. It's an administrative maneuver. It's not changing what you own, just which bucket you keep it in. But let's ground this in reality for a second. Let's say a listener has done everything right. They listened to this deep dive, they built the perfect complex plan, they have the CRTs, the Roth ladders, the flawless asset location.
The perfect setup.
But life throws a curveball. What happens if a listener's life changes unexpectedly and their high income from 2024 no longer reflects their reality in 2026? Say they get sick or they lose their job. Is there an escape hatch, or are they stuck paying premiums based on a ghost of their past wealth?
There is an official escape hatch, formerly known as the Life-Changing Event Appeal, or Form SSA 44.
The government does recognize that a rigid 2-year look-back is deeply unfair if your life circumstances have fundamentally, permanently shifted.
So what counts as a fundamental shift in the eyes of the government?
The Social Security Administration provides a very strict, specific list of qualifying events. These include marriage, divorce, the death of a spouse, the loss of pension income, or, most commonly for the demographic we're discussing today, a work stoppage or work reduction. In everyday terms, retiring.
Let me make sure I understand the mechanics of this appeal. Let's say I retire mid-year in 2024. My final W-2 for that year looks absolutely huge because maybe I got a severance package or I cashed out months of accumulated vacation days.
Sure, very common. But by 2026, I'm fully retired and living on much less. I can use this form, SSA 44, to formally tell the government, hey, I don't make that W-2 money anymore. Please calculate my IRMAA tier using my current lower income.
Yes, if it's tied to a formal work stoppage, they will recalculate your premium based on an estimate of your new lower reality.
But wait, let's test the boundaries of this. What if I didn't retire? What if I'm still working, but in 2024, I had a massive one-off event? Say I sold a vacation home, or I liquidated a huge chunk of Apple stock to buy a boat. Can I use the form to say, hey, that was a one-time thing, don't count it?
Absolutely not. And this is a vital distinction for listeners to understand. A one-time capital gain, like selling a vacation home, cashing out stock for a boat, or doing a massive Roth conversion, does not qualify as a life-changing event under any circumstances.
It's just extra money to them.
Right. It is simply an income event. The Social Security Administration will look at that appeal, deny it, and demand you pay the maximum surcharge.
Ouch. So you really have to know the difference between a life event and a wealth event.
You do. And this brings us to perhaps the most terrifying concept in this entire deep dive. The tax torpedo.
The tax torpedo.
Yeah, because you have to understand, IRMAA does not operate in a vacuum. A single extra dollar of income that pushes you over an IRMAA threshold doesn't just trigger thousands in Medicare surcharges. That exact same high MAGI is also cascading across several other tax systems simultaneously.
It's a domino effect. $1 tips over a whole line of taxes. Walk us through the layers of this torpedo.
Consider the math of crossing that threshold. Layer 1, you hit the IRMAA cliff, triggering up to a $10,000 penalty. Layer 2, that same high MAGI forces up to 85% of your Social Security benefits to become fully taxable.
Oh, man.
Layer 3, crossing high income thresholds, triggers the 3.8% net investment income tax, or NIT, on your capital gains.
Yeah.
Layer 4, it can push your underlying long-term capital gains rate from 15% up to 20%.
So that one extra dollar of income you realized because you wanted to buy a boat might cost you exponentially more across 4 completely different taxation systems at the exact same time.
Exactly. You cannot manage IRMAA in isolation. You must manage all of these thresholds concurrently.
So what does this all mean? We've covered incredible ground today. We've talked about diffusing the RMD time bomb with Roth conversions before age 63. We've explored how qualified charitable distributions can invisibly erase income for those over 70.
The QCDs, yes.
We unpacked the damn concept of charitable remainder trusts to protect massive business sales. We highlighted the critical need to hide yield through strategic asset location, avoiding the muni bond trap. And we examined the strict boundaries of the SSA 44 escape hatch to avoid the devastating tax torpedo.
It is a formidable, highly effective arsenal. But what should be glaringly obvious to anyone listening is that these are not weekend DIY projects.
Definitely not.
You do not just log into a brokerage account and guess your way through setting up a charitable remainder trust or executing a multi-year Roth conversion ladder. These strategies require the coordinated, forward-looking eye of a professional fiduciary. They require sophisticated tax projections that look 5, 10, and even 20 years into the future.
Absolutely. You need a team that understands how the dominoes fall, someone who can look at the whole board. And that is exactly what Thomas Davies and his team at Davies Wealth Management provide. They are uniquely positioned to help high-net-worth retirees, executives, and business owners navigate this exact maze.
They really are.
If you want to see how these stealth taxes might be secretly eroding your perfect retirement plan, Davies Wealth Management offers a comprehensive Medicare IRMAA planning guide, and they also offer a complimentary fiduciary audit. It is a no-obligation way to get a professional set of eyes on your boat to see if you have any hidden leaks below the waterline.
The peace of mind that comes from knowing your blind spots are mathematically covered is truly invaluable.
Completely agree. We've pulled back the curtain on how the system really works, but before we sign off, I want to leave you with one final thought. We started by talking about that pristine, perfectly planned yacht with a massive leak. We now know that Medicare operates like a bizarre time machine, judging your future wealth based on the ghosts of your past tax returns. So ask yourself this. If every financial decision you make today casts a 2-year look-back shadow into your future, what hidden shadow is your portfolio casting right now that you won't even see until 2028?
That is a powerful question to consider.
Check your hull, patch the leaks. We'll catch you on the next deep dive.